Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so again, you can pull these same symbols, the $ BPX, over at quote.com. You can pull up the GBP, and you can see in the upper left-hand corner the GBP space A0 hyphen FX. That would be the underlying spot. And so you can play around with these overlays and get a feel for how these FX symbols will go over your spot. Again, I'm working from that spot because that's where a lot of people are initially moving into understanding how Forex works. And then if you can take that understanding of the spot market and then apply that to, okay, in this scenario, an option would be better suited to taking advantage of this market cycle, then you're really getting the best of both worlds. So I am unfortunately going to have to restart my computer here. Didn't like something I did. Okay. Let me take a couple of the notes of these questions here while I restart this.
I guess questions like the time frame is what a lot of the attendees are asking. How do you decide, if it's looking negative in a monthly chart or a weekly chart, but the very short-term chart is positive, how do you balance all of that information?
Okay, that's a fantastic question. We'll tackle that right now. Okay, so understanding your time frames. Let's go ahead and operate from. And I just cut the video, so if you lost the video, don't worry. I'm just restarting my computer right now. From a time frame perspective, here's where you've got to make some quick analysis, and it's very easy to do. Now, for those of you that are not familiar with what I call the wave is a trio of moving averages set on the 34 period. I have a free video about the wave over at the educational site, Raghee.com, which is basically my first name, .com, and there's free video on the wave. But let me tell you what it is. It's the 34 EMA, and you're actually going to do 3 individual exponential moving averages. You're going to set one on the high, one on the low, and one on the close. Now, if you go to Google and you just Google my first name, Raghee, and then wave, you'll get plenty of video from a number of sites that we have video or explanations on. But again, it's the 34 period, which for you Fibonacci buffs out there, you might recognize the Fibonacci number. It's the 34 exponential moving average, one set on the high, one set on the low, and one set on the close. Now, any decent charting platform will allow you to do this, and with a lot of brokers having better and better charting, this should be something that's relatively simple to do. If you can't set 3 exponential moving averages, especially some people have trouble with getting the high and the low calculation, go ahead and just do the close. That's better than nothing. And what we're looking to do with those series of moving averages is basically determine the market cycle. Now, here's where it pertains specifically to the time frame question. Whether you buy a put or a call is going to depend upon, and whether you have a neutral market is going to depend upon what that underlying time frame is doing. So if you prefer very short-term options trading, you don't want to necessarily be in the option for more than 4 or 5 days, or you prefer, let's say you look at an option and say, you know what, I'd rather have an option closer to the money, pay for the strike price, and give myself less time. That's fine, but I would highly recommend then you look at a shorter term intraday time frame and look for those market cycles that get quiet, 3 o'clock wave on a 30, 60, or maybe even 180-minute chart. And that, again, is if your preference is for a shorter holding time and perhaps you'd rather pay more for being close to the money in terms of current price action with less time. So you're a little bit more exposed to time decay, but you've got a better strike price in terms of better being closer to the current price action. I think the shorter-term time frames will be best, and that's when you look for those sideways consolidation-type market cycles. Now, let's say you would rather hold it a little bit longer. Let's say you're trading off a daily chart. So again, your decision isn't necessarily going to be solely your preference, but it's going to be your preference plus the correct underlying market cycle. I hope I'm getting that across clearly. Now, if you like, say, a daily chart, and you'd like to hold this thing a little bit longer, you noticed on the dollar-yen example and looking at the YUK symbol, I liked using the 30-minute chart because that was the one that was moving sideways, the 30 or the 60. And then I was all right with having only 19 days to expiration with the October contract. Okay. Now, if I jump out to something like the daily chart like we just did on the EUI and the Euro-US dollar, if I jump out to something like that, then I'm going to be looking at having some more time. So that's where that November or that Christmas contract is going to be more, or the December contract is going to be a little bit more well-suited for the unknown of something slower like a daily. So to answer your question, that's how I determine which time frame I'm going to be focusing on. And then again, focusing on those sideways market cycles. So if you're looking for a sideways market cycle across multiple time frames and you end up finding one on the short-term intraday, like a 30-60, go ahead and look for that nearer options expiration contract, but then looking for something a little bit closer to strike price. To me, you're always balancing strike price versus your expiration. So that's kind of the long answer to that question. I hope that helps. And I'm just now hopefully getting back here into the room. So just bear with me here. But did that help there? Was that helpful in terms of understanding how to capitalize on that? Hopefully that was. There was another question regarding the size of the oscillation, and I'm glad you asked that question. There was a question regarding, when I've got I think the question regarded 300 pips or something like that. When you've got a wider ranging oscillation, then what you're going to find is that if the oscillation is extremely wide, and let me get my charts back up, we should be able to get back on track here. Just bear with me one moment. Okay, so depending upon the size of the oscillation, 300 pips is a healthy sideways market, and rather than accumulation, I'd have to say that's closer to a distribution market, and you will likely pay up for the bit of volatility, but not as much as if the market has already exploded outside the range. Okay? So keep in mind, while distribution certainly is not as enviable as accumulation, and if you don't know the difference, accumulation is going to be a wider ranging, accumulation is going to be a narrower ranging sideways market, while distribution is a wider ranging sideways market. Okay? So taking a look at the underlying market cycle and the type of sideways market you're getting is going to make a big difference in your price, but I think it's still better off than buying within the context of a trend. Now, you'll notice in the example of the EUI, I'm actually looking for more of a contrarian position. Why? I don't like looking for tops and bottoms with the underlying spot. When I was out in Vegas and we had the ISC presentation out at the last the Forex Expo. I don't know how many folks were out in Vegas for that. One of the things we talked about is my husband's love of top and bottom picking, but he knows better. He's not looking to do that with. Okay, I'm back in the room here. So hopefully
I see you, although
okay.
Now, unfortunately, it looks like not sure if. Let me see what I can do here.
Okay.
Change roll to. Let's see. Okay, I doesn't know. I can hear you though, so I'm not sure why the phone is saying you're not here. But can everybody else hear, Raghee? I assume that you can. Let's see if you can actually just type a yeah. Great, Raghee. See if you can actually share. See what happens next. Great. Everybody can hear you.
Yeah, it doesn't think I'm a presenter.
Exactly, but I've given you control, so let's see how it works.
Let's try
Excellent.
that.
We're good.
We're good? All right. You the man.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.